Hello and welcome to the first ever live episode of Nothing Ventured with me, Aarish. Really excited to be doing this, and do bear with us if we have any technical difficulties. It is my first time, but you know what they say, if you don't try, you never know. Today, I'm super excited to have with me Peter Walker. Peter is the head of insights at Carta, the one-stop shop for everything equity related, providing tools to assist with cap table management, employee share plans and valuations, as well as products for VCs to manage their fund admin and formation, plus much more besides. Now, we're going to be taking a deep dive into Carta's Q3 23 State of the Private Markets report. Peter is going to take us through that sort of issue by issue, looking at the highlights and the lowlights. But for the meantime, Peter, really great to have you here with me. Thank you so much for agreeing to do this. And maybe for the audience, could you give us a couple of minutes about what you do, how you came to work with Carta, and what you're doing today with them? It would be great to understand a little bit more.
Absolutely. Yeah. Pleasure to be here, y'all. Apologies for the slightly hostage video quality I didn't realize the live show was going to be going. So I'm here at the Carta offices in San Francisco. But yeah, my name is Peter. As you mentioned, I'm the head of insights at Carta. And Carta, for those of you that are not super familiar, we work with about 40,000 startups now that use our cap table management software to issue equity to everyone in their company. So that's to employees, advisors, investors. And through that mechanism, we can track how all of the distinct metrics from those companies are moving over time. So it gives us wonderful and accurate data on things like startup valuations, round sizes, the dilution in given rounds, safes and convertible notes, all of these slightly opaque parts of the venture market. We have fantastic data on, and Carta is the kind of company that brings someone like me on to tell everyone else about it. So my whole role is dedicated to making the data that Carta has more useful to the external ecosystem. I count it as a win if a founder and an investor cite my data as they're looking through their negotiation, just to try to ground everyone in the reality of what's happening in the venture market. And hopefully that enables deals to be done faster. And then, of course, that ladders up to the overall goal of Carta, which is to increase the number of startups in the world, and then by then create more owners, which is why we go to work every day. So we've got a ton of data. We'll get into a lot of it today, but not all of it. So if there are things that you wish we had touched on, leave comments and or shoot me an email, and I'm happy to kind of play through the data that we have access to in the future as well.
Amazing. And yeah, absolutely, guys. This is a live session, so you can ask questions whenever you want, and we will hopefully be able to get to them. And I guess the thing it's worth saying, one of the reasons I really wanted to talk to you, Peter, is because your Data Minute newsletter is probably one of the few that actually gets read in my inbox, if I'm honest. And as someone who writes newsletters, I'm probably loath to even say that. But the reality is that the really kind of quick bites of insights that you guys give is really valuable when you're operating in the early stage ecosystem. So I guess without further ado, why don't we get some of that data up on the screen, and let's dive straight in.
Let's do it. Okay. I'm just pulling this up really quick. So to give a little context on where this data comes from, again, we put out this State of Private Markets quarterly report. It's got a host of different data metrics from across our various businesses, but primarily this is drawn directly from the cap tables of those 40,000 or so startups that use Carta today. Give you a little bit of breakdown about who those startups are up at the top. About 11,000 of that 40,000 are actually startups that are using our Carta Launch product. And that is the earliest part of Carta. It's the entire cap table suite, completely for free, until you've raised $1 million US. So that 11,000 figure, those are startups that are, idea stage. Maybe they've raised a little bit on safes and convertible notes, but they're really just kicking off their businesses. So as you're looking through some of this data, just know that we're going to touch on those pre-seed companies a little bit, but the vast majority of this is going to come from the standard venture ecosystem stack. So seed, Series A, Series B, all the way up and down the run here.
Yeah, and I think it's important to understand that 40,000 odd company data set is pretty strong, right? Like you're likely to have good coverage and be able to extrapolate quite well out of that. I guess if you were sitting on 1,000 startups, it might be a very, very different picture. But I guess you're able to track those through. And just to give us a bit of a flavor for kind of the longevity of some of these startups on platform, like how long are they actually on there for? How far into their journeys do you see?
Yeah, so typically a startup will come to, it used to be that people would come to Carta once they've started raising their venture round, so probably like a price seed or Series A is when they would join the platform, and then they typically exit as they IPO or are acquired. So we don't really have any public companies on the platform anymore. It's an entirely private market ecosystem that we focus on. But these days, a Carta company might come to us as an idea and exit as an IPO company. So that's the goal.
Yeah, amazing. Well, let's dive straight into the data then.
All right, let's do it. Well, from that cheery subject to perhaps one that is unsurprising but not quite as cheery. So let's start with the basics, overall priced equity fundraising. So all the price rounds that you read about in TechCrunch and other places. Across Carta, if you just follow that black line, our startups collectively raised $66 billion in Q4 of 2021. And you can see that was a massive leap from what had been going on in 2019 and 2018. And unfortunately, the crash has been basically just as rapid.
Wow.
So in the last quarter, Q3 of 2023, those same startups collectively raised just under $12 billion. So from 66 to 12 in the period of, call it, 2 years. That is a real whiplash. And that lack of funding is probably the hidden reason behind all of the other metrics that we're going to talk about today. You can see that there's an estimate bubble for the little round sizes there. The black line is level of fundraising. The gray bars are just total rounds in a quarter.
Yeah.
Some of our data does lag a little bit and it can come in a little late, but there's no denying that Q3 was a rough time for a lot of entrepreneurs.
I don't think we're going to see 50 billion of deals suddenly announced in the next couple of days from Q3. I mean, what's really interesting to me there is obviously you've seen a reversion back to kind of the 11 billion, odd mark, 10, 11 billion is going back to kind of Q1 2018, so really kind of has gone right back, and that's juxtaposed over actually still obscene amounts of dry capital in the market. So it's not that there isn't capital out there waiting to deploy, but just startups have not been able to raise a huge amount of that capital.
Completely. And actually, I mean, I think you and I could talk for ages about the idea of dry powder. It kind of gets thrown around in these interesting ways, and it's not that it's not real. It certainly does exist, and I don't expect a lot of these fund managers to end up giving any of that capital back to LPs. That's not what's going to happen. However, what we are seeing is that dry powder is likely, a lot less of it than you might expect is going to be deployed into net new bets. So a lot of that capital is going to go to follow-ons for current portfolio companies, extension rounds, bridges, trying to tide these entrepreneurs over until they can raise their next primary round. And that's just going to leave less than you expect for the new entrepreneurs that are coming up.
Yeah, absolutely. I mean, stark numbers, though, whichever way you kind of skin it, that's a pretty significant drop.
Absolutely. And so, again, looking at that drop, we're just talking about the difference in capital raised over quarters. So those percentages, just assume that is the percentage relative to Q4 of 2021, which we just saw was the peak last year. You can see each of these lines represents a stage in the venture ecosystem: seed, Series A, Series B. Everything is down, but seed and pre-seed companies are actually doing better than the later stages. It's not shown in the chart right now, but Series D and Series E, those are really close to IPO companies, those have raised even less capital on a percentage basis. So the further along you were in your startup journey, the more difficult that whiplash has been over the last 2 years.
Yeah, and I think that's that's a fairly understandable kind of metric, because if you think about fundraising over the last several years, what you would have probably seen is a number of later stage businesses raising at relatively high valuations. Now they've got to grow into those valuations. They've got to show the traction. Obviously, markets in general are off, like economy has been off for the last couple of years as well. So they maybe haven't had the traction that they would have had expected to see. And I guess at seed, on the other hand, you're essentially taking a bet very much on the future. It's not necessarily based on very hard metrics. You're essentially, funding a business plan and an idea and a market. So I guess while seed is down, it makes sense to me that it's less down than sort of A through sort of E rounds.
Definitely, and there's been a shift in the market. There's been a lot of people who say we used to be a Series A, Series B fund, but we're far more interested in the earlier part of the market now. There is some of that happening, and that sort of leads directly into this next chart, which shows the sort of dashed lines in this chart are the pre-money valuations of companies relative to the peak in Q4 21, and the solid lines are the total amount of capital raised. So again, essentially what's happening is at the later stages, valuations and fundraising fell, maybe not in tandem, but close to one another. And at the early stages, volume of capital has fallen, but valuations have remained honestly fairly robust. Like the idea that the median price seed valuation on Carta is actually up from Q4 of 2021, given all the turmoil in the market, was kind of surprising to me. And it just speaks to the difference at that early stage where you're not taking bets so much on economics. It's much more on vision, founder, and like the idea of a market in 10 years. So you're not actually that worried that no one's IPOing at the moment.
Yeah, 100%. And what's interesting is, whilst you say the valuations haven't fallen alongside the investment, I mean, they have. they've just they've improved slightly at Series A, B, and C, but they're still substantially down from where they were as compared to
100%.
C.
Yeah, definitely. This is, I don't have this in any of the charts, but there is no doubt that interest rates and the change in interest rates moving from costless money to very costly money has had a massive impact across startups. And I think that's part of that for sure. So getting back to the dry powder debate we were just having, where are venture capitalists spending their time and attention these days? More and more of it is going to bridge rounds or extensions. And just to parse this out a little bit more, a bridge round in this definition is not a safe or a convertible note. It is a priced round that's raised at essentially a flat or just perhaps a little bit raised valuation to the last price round, but it doesn't move from Series A to Series B. It's essentially your second Series A round or your second Series B round. And you can see the black lines in each of these charts, the percentage of all the rounds in a given series that are bridge versus primaries has never been higher across Carta. So, and you tell me whether or not this is happening across your vantage point as well. What seems to be going on is that portfolio companies are going back to their current investors and saying, look, we had a plan, the world changed, we're going to need more capital in order to achieve the thing that we wanted to achieve. Will you back us again? And then those VCs are going to have to choose amongst basically all of their portfolio companies, who are we going to double down on? That's pretty common in VC, but what's uncommon is all of those companies going back for money at the same time.
Yeah, the only other time that this probably would have happened was during the pandemic, I guess, right? And exactly to your point, we're seeing inside rounds happening, more and more, extension rounds, whether that's because revenue expectations haven't been hit, or costs have spiraled and runway has sort of been challenging. But very much, I think founders in general are also slightly wary of going out for that price round as well, or for the larger price round, for that primary round, because again, there may be concern about having to. And I know we're going to get into these numbers later, so I kind of want to hold back a little bit. But the dreaded down round and so on is obviously playing on a lot of people's minds, right?
Absolutely. Yeah. Some of this, that's a good point though, is that this isn't all driven by VC behavior. This is also, dependent on founder behavior, who perhaps doesn't want to go out to the market right now and is doing everything they can to avoid it, which makes a lot of sense. The other thing that founders are doing, which is a pretty big shift from prior years, is they now have sort of discovered this new option of financing between rounds. and that's convertible financing. So either a SAFE or a convertible note. As you move further along the company journey, a SAFE becomes less and less utilized, which is pretty obvious. If you're a mature Series B company, you probably should be taking on convertible notes that are actually debt, and your investors are seeing some interest from them. Whereas a SAFE is sort of the modal, the primary way that they fundraise on these convertibles at the earliest part of the market. But I just think the general takeaway from this chart is there has been an explosion of interest in convertible financing to tide people over in this interim before, I don't know when people think the market is going to reopen to full health. There's not going to be one date at which that happens, but a lot more time and attention being spent by founders on these SAFE and convertible rounds as well.
Yeah, and I mean, like if you're in generative AI, the market has fully reopened, right? Versus
Correct.
Versus
right.
others, and I think I think that the couple of things that I would say on this especially is that, again, going back to what we just said earlier, a SAFE allows you to defer that valuation question until later. So that for a lot of founders is one of the reasons I think that they may be looking more at SAFEs. It's also certainly here in the UK, and there's a couple of instruments that are used, the SAFE is one, but more typically, especially when they're raising from more tax incentivized investors like angels, they use the ASA, which is Advanced Subscription Agreement. They're just quicker to close because you don't have to go through that conversation around valuation, around pricing the round, and therefore it's much easier to get that cash in on the promise of a future raise at a price round, which obviously is offered then at a discount to those that came in on the SAFE. It doesn't surprise me at all that this is happening right now.
Yeah, and that idea of not just time and effort and, of course, legal cost spent, but the idea that you don't, at that exact moment, need to assign a direct valuation. You can essentially assign a valuation cap, which functions as a sort of a range profile for your investors. It's just a more risk-adjusted. I think the SAFE has been really beneficial to a lot of U.S. startups in this time period. There are downsides, perhaps some terms that you want to be careful about, but on the whole, I think they've been really good for the market. Which, we were mentioning this earlier, if you can't raise on an extension and your investors, or you can't find angels who are excited about a SAFE and convertible, unfortunately, a lot of founders are having to take on a down round at this point. So each of those orange bars is the percentage of down rounds across each stage this year versus prior years. You can see it's exploded, especially in the later part of the market. Now, I've always found this very interesting about private tech, or at least the early startup market. There are companies on the NASDAQ that get revalued down every single day. Yeah. And the stigma is not attached to that down round, whereas even in a less opaque, less information-heavy market, I would expect more down rounds on a general basis. But there's such a negative signal around a down round in venture that people do everything they can to avoid it. So in some ways, I kind of take these numbers as a bit of a silver lining. It means that founders and investors are actually agreeing that perhaps they were both a little too excited in the past couple of years, and it's okay to recapitalize the company. But there's no denying it's a tough moment. You have to explain it to the public, you have to explain it to your employees, and it can be really difficult for a founder.
Yeah, I mean, I guess going back like 4 or 5 years, 5 years, maybe pre-pandemic, and I think, again, the pandemic was a real mindset shift for a lot of people because they were forced into doing things that they would have not necessarily have considered in the past. But, prior to the pandemic, for sure, founders that I spoke to or that I worked with would have been essentially completely against taking a down round. They would rather not raise than raise on a lower valuation and find, again, other ways to maybe bridge, whether that's via a convertible, an inside round, something else, an extension to the prior round often, right?
Sure.
But I think exactly to your point, like where capital is not flowing as quickly or as exuberantly as it has been over the last several years, there is nothing wrong with that down round. Like who does it really impact? And I guess this is the problem. It impacts probably earlier stage investors more than later stage investors, often who are protected with liquidation preferences and so on, although they can potentially be impacted as well. But you touched on it there. It has a real impact on employee sort of stock options. And we saw like in 2021, 2022, there was a lot of noise around the fact that a lot of employees' stock options were underwater, i.e. the value of their stock options was less than the value of the company, or rather the price of their stock options was less than the last price round of the company. So it definitely has an impact. But I guess to your point, any ship in a storm kind of thing, right? Like if you're a founder and you are passionate and you believe your business has the legs to get through this period, then if you need the capital, you're going to do what needs to be done.
Completely agree. And as you mentioned, the people who suffer the most in a down round are typically employees, and quite honestly, they sometimes don't even know that is happening, right? Because they're a little bit disconnected from the fundraising mechanics oftentimes, especially at a startup that has a reasonable number of employees, 100, 200 or more. And then they can come to an exercise decision and realize, hey, the fair market value of my stock is actually below what it would have been, or what the market is valuing those shares at the moment, and it's not worth it for me to exercise. And that leaves them out of the upside of the business. There are multiple examples of great businesses being built, IPO scale businesses being built after a down round. It's our hope at Carta that employees get to share in that. But back to the fundraising dynamics here. Time between rounds. This is always sort of an interesting one for entrepreneurs. This is, to be clear, the time between a priced seed and a priced Series A, or a priced Series A and a priced Series B. So founders are doing all sorts of things in the meantime, those convertibles, other things. But in general, you can see a drift upwards in both the mean and the median days between these rounds. The big spike there at the end for Q3 from Series B to Series C sort of points to a bit of a crisis moment that's happening in mid-growth, which is these Series B companies that perhaps raised their Series B in 2021, they're running out of options. They've probably done layoffs. They've refactored their software stack. They've extended their burn rate, but that only can last for so long. So at some point, those companies are going to either need to undertake a round of primary financing, perhaps a down round, or they're going to need to think about strategic alternatives. And that's a lot of companies faced with those decisions right now.
Yeah, 100%. And again, we kind of, I think we'll see it later on in the slides, but there are multiple options. Of course, the worst option being, folding the company. And we've seen a spate of those happening. I mean, notwithstanding the big WeWork news, but, certainly there are a number of businesses that have decided that, they can't continue and they've wound up. And then of course the other options are potentially, the down round. They're potentially looking at M&A and seeing whether they can source an exit, maybe to a competitor or whatever it might be. But yeah, the problem is that, to get from Series B to Series C and beyond is now becoming, tougher. And VCs are less inclined to just pump the money in if those businesses are not proving the sort of growth metrics and the unit economics that they would hope to see.
Totally. And that brings us to, when we take a look at the deals that are actually happening, one of the things that was very clear over the past year or so is that the negotiation power in these deals has swung back to the investor. So we were seeing terms like high liquidation preferences, participating preferred stock, cumulative dividends, things that favor the investor over the founder in these negotiations. We were seeing those appear in more and more term sheets. So the percentages here are the percentage of deals with a given term included in them.
Yeah.
And you can see that in the beginning part of 2023, those were on the rise. Something interesting happened in the last quarter, though, is that the frequency of all of those terms fell pretty drastically. Liquidation preferences went from appearing in about 7% of deals to less than 2% of deals. And while this on the face of it looks founder friendly, unfortunately what we think is just happening is that instead of doing deals with these terms included, VCs are just not doing the deals at all.
Yeah.
So it's a little bit of a not quite as a rosy outlook there.
Yeah. And I think, again, important, right, just again for the audience that may not understand, so liquidation preference obviously means that VCs or investors can take typically, at least one time. You've obviously got greater than 1x liquidation preference, but it basically means they can recover their initial investment before any other distribution on an exit or a wind up or anything else, which often will mean that both founders and employees are left essentially with not very much, and participation obviously means that they may have the liquidation preference but also be able to participate in the waterfall thereafter. And the cumulative dividends are exactly what they sound like, accrued dividends over time, which then get paid out to those investors ahead of other investors and so on. And yeah, I think I'd agree with you. It's probably more likely that what we're seeing is there are just fewer deals being done. Therefore, as a percentage of those fewer deals, you're not seeing those sort of terms. But yeah, I wouldn't be surprised to see that uptick again as more deals are done. I don't think we're getting back to kind of super founder friendly terms, in the near term.
No, those are all just indications that having a great lawyer is usually worth the cost of admission there.
Yeah.
Which brings us perhaps to the most depressing slide, if I'm being honest, in this whole deck, which is startup shutdowns. So we've all kind of been waiting. Look, if there was a boom in startups in 2020 and 2021, and the world has shifted, and we don't expect many of those businesses to be able to make the shift, then we should be seeing more closures happening. And we really started to see it in Q3. That's the most 229 businesses using Carta cap table that went bankrupt in that quarter. That's an undercount. We don't have perfect data on this, but the startups that told us the reason that they were going out of business was due to bankruptcy or dissolution was 229. That's the most we've ever seen. I expect it to grow more in Q4 and unfortunately probably into Q1 and Q2 of 2024. So there's just a lot of startups that are going to kind of be left in the lurch here and unable to pivot to the new world.
So one question, I guess, maybe on that is, what is the lifetime of those ventures? Like on average, do you think that these are businesses that are 3-4 years old, or are they 5, 6, 7 years old, or are they kind of the very early stage? Because I kind of have a feeling that there may be some businesses that launched in probably 2020, 2021, got priced at ridiculous valuations, weren't able to keep up, weren't able to grow into them, and maybe they're sort of shutting down. But which I think would be healthy, probably more than anything else, because they probably haven't raised so much capital and haven't destroyed so much value. But I think what would be really, really problematic is if we're talking about kind of those Series B, C, D kind of startups that are suddenly starting to shut down, which I presume is probably the case as well, though.
Yeah, so it's kind of a tale of two cities there. Certainly, the majority of the startups represented by this chart are startups that maybe raised. There's no startup on this chart, I should say, that has raised no funding. So I just kind of eliminated them from the list. So they've raised some funding. A lot of them will have raised pre-seed and seed and not gotten beyond that. So there's a healthy dose of that happening. However, if you were to break it out, I don't have that chart in this one, but if you were to break it out into the various stages, each stage relatively has seen more shutdowns this year than other years in the past. So Series B, Series C, I think it was basically, if you looked at companies that had raised at least $10 million, about 2 times as many have shut down in 2023 as did in 2022, and about 3.5 times as many as in 2021. So it's not just the smallest companies. This is impacting, pretty reasonable sized businesses as well.
Yeah, that's I mean, sadly what I was expecting, but I guess it's again the old adage, right? Great companies are built in hard times, and maybe again what we're seeing is some of those almost tourist kind of ventures maybe falling over. Not that that's a great thing for anyone, founders, employees, or investors, but I guess it's also part of the natural cycle, right?
Totally, yeah. And it's, the more startups, the more salient those headlines, the more likely it is that you're going to encounter one that shuts down. There's a denominator effect here as well, but no denying it's a tough moment. All right, so we talked a little bit about general fundraising. Let's just get into the specifics of what's going on in the current market for any entrepreneurs or VCs on the call. here's the data that we have for primary seed round valuations. This is US companies that are using Carta cap table. The black line is the primary median seed valuation. The orange line is the bridge seed round valuation, both on a pre-money basis. And then the bars in the chart just represent the total number of rounds that got completed that quarter. So you can see, again, from about almost 900 rounds in Q4 21 to just under 500 in Q3 2023. So a fall off there in activity. But valuations at seed stage still quite healthy. You know, 13.3 million for a primary round seed valuation. That's a good number if you compare it to prior years on Carta and elsewhere. So I would say that for the companies that are able to raise, the valuations and round sizes are still rather robust at this early part of the market.
Yeah, and that I think goes back to what we said earlier, because again, you've got less data to value on, so you are valuing essentially on the promise of the vision and so on. Although it is interesting to see in Q4 21 a kind of 19 million median bridge round valuation, 20 million in Q2 2022. I guess that was really the peak of the market, and it was all kind of downhill after that.
Yeah, those were the boom times, you know. It's sad to see them go. So shifting to Series A then, median valuation for a primary Series A on Carta is about 40 million. And interestingly, the bridge round valuation for this last quarter is also exactly 40 million, which is a negative signal in my view. A bridge round obviously happens after the primary round, so you would expect that to be at least a little bit higher. What this indicates to me is that there's a lot of flat rounds going on.
Yeah.
A lot of just simple extensions where the current investors are taking on more allocation, but the valuation isn't changing, even though the business is probably further along. And the dynamic there is, yes, the business may have more revenue and be further along than it was before, but the expectations have changed even greater than the progress in the business itself. So it's sort of a moving goalpost here for founders.
Yeah, 100%. Or alternatively, that they raised at a higher than realistic valuation in the past, and therefore this is just now that kind of almost like a down round. It's essentially coming back to basics.
100%. Yeah, that's a great point as well. On the Series B side, Series Bs are going off on Carta in the US at about 90 million for a primary Series B. The bridge rounds, there's just not a lot of them happening. That's why that's lower than the primary there. I think, in my worldview of the market, there's sort of an accordion effect. Like, we had this big shift happen in the public markets, and it marched its way down the venture series from E to D to C to B to A. And it's just now getting to the A and seed rounds, really. Yes, there's been a decline, but I don't think there's going to be a major one. The middle part of the venture market is really where the rubber's meeting the road. It is very difficult to raise a Series B, C, or D round right now. Yeah. Probably more difficult than it's been in the last, I would say, 8 to 10 years.
Yeah, and I think, again, like, we've had plenty of sort of later stage investors on the podcast, who've told us, there is that compression happening in those later stages. One investor described it as, when you are raising at sort of A, it's about product market fit. When you're raising at B, C, D, it's about go to market fit, and have those founders proven that repeatable, replicable model that allows them to continue to expand, at pace. And I think probably what we're seeing is a lot of people probably raising those B, C rounds a bit earlier in the past, where it probably was sort of really they were at Series A, but they were able to take advantage of what was happening in the markets, and now obviously struggling to fill those valuations that they came into. I mean, I think it is really interesting that you're seeing that kind of drop in the medium bridge that goes below the sort of medium primary round for Series B. That's definitely indicative of definite pain in that side of the market.
Yeah, pain ahead. Yeah, that's a clear signal for me as well. When it comes to how much of the company entrepreneurs are giving or selling to investors, in each of these rounds, that quite honestly hasn't changed very much from the standard rules of thumb that you hear across venture. It's 20% or so of the company in a price seed round, about 20% in your Series A, and then on down the stack for Series B, C, and D. So And then I've mapped it out a little bit as a distribution, so you can see that it goes from under 5% or over 30% they're sold around. You can see it sort of like shift as a heat map down towards the lower left. Basically, the overall takeaway here is I think it's been good to see that the investors are not demanding incredibly high percentages of companies as sort of extracting those in this moment. Now, a lot of that is just they're not doing the deal in the first place, which again, chicken and egg there for the entrepreneur. But generally speaking, a lot of the best investors are still sort of trying to take the allocation that makes sense for their fund and sort of no more than that in many cases.
Yeah, it's kind of down to portfolio construction on the one side, but also, I think there's an obvious understanding from investors that if you take too much of the company away from the founders, all you're going to be left with is a disincentivized founding team and or employees, and that's just not going to be healthy overall. So, but the flip side of that is, yes, they are selling, they are acquiring the same sort of percentage of the company, but they are layering in those additional terms that we talked about a bit earlier, whether it's liquidation preferences, whether it's board seats, whether it's participation rights, etc., etc. And that's, I guess, where they make up for that quote unquote shortfall, maybe.
Absolutely, the devil's in the details on these deals, for sure. All right, so jumping now from sort of the price, general valuations, and fundraising data into the earliest part of the market, where we're terming pre-seed. Now, I want to be very specific when we talk about this. Pre-seed to us at Carta simply means anything that happens on safes and convertible notes before you raise the price round.
Got it.
Now, there's obvious pushback probably from your audience already that would say, look, at some point, even if you're raising on safes, that should count as a quote-unquote seed round. And we agree. Seed is just a term that's kind of thrown around, and it's very amorphous these days. So what we did was we broke out all of the safe activity that we have on the platform before you raised any price round. And there are there are rounds that are being done on Carta right now for very early companies where they're raising $5 million or more on a safe round instead of doing a price round. And that's typically, quite honestly, mostly to save on legal costs or time and effort. So the safe has become this instrument that plays across all different kinds of businesses. But when you break out the valuation caps of those safes by the amount that's raised, you can see that basically if you're raising between $500K and $1 million in a safe round, the median valuation cap on Carta these days is 10 million.
Yeah.
If you're going to raise essentially what you would call a friends and family round, or the very earliest part, less than 250K, your valuation caps are more like 5 million.
Yeah.
So just a point for entrepreneurs on the call, you may hear a lot of data thrown around safes. It's important to right size the valuation cap that you are trying to raise at with the amount of fundraising that you actually need, because that is where this conversion to dilution happens, and you can end up owning less of your business than you expected.
Yeah. And importantly, I guess, and Carta, I believe, allows you to do this, is to work out the waterfall and how that dilution impacts over time, right? Because exactly to your point, I mean, I think I just had a conversation with a founder just the other day on exactly this. They're looking to price a small pre-seed and then extend that with a safe convertible ACE or whatever it might end up being. And my kind of advice to them was, well, you got to be careful now about not pricing your price round too high, because otherwise you're gonna have trouble setting your valuation cap on the safe or the convertible, which means that you're gonna have to raise at a very high valuation to make sure you can be right. So you exactly as you say, you got to make sure that it's comparable and commensurate with the amount that you're raising, as well as the stage you're raising, and exactly kind of the conversion terms as well. But that's super interesting. And I think, 5 million for under 250K, here in the UK, that would probably be considered quite high. If I'm honest, in the UK, you tend to see the kind of pre-seed very early, anywhere between £0 and £500,000 raise, probably raising anywhere from 1.5 to 3, maybe 4 million. If you're a second-time founder, if you've been through one of the big companies, etc., that may change, obviously. But for most founders raising for the first time, these numbers would definitely be exciting for them compared to what we see here in the UK.
And to be clear, that is a piece of feedback that we hear a lot. And the point to keep in mind when we're looking at this data is, it is it plays across the entirety of the United States. So if you're in London or other places, it might not match exactly. But also there's significant differences within the states themselves. You know, a Silicon Valley startup started by a repeat founder is just going to command more attention and higher metrics in many cases than, you know, your typical Dallas entrepreneur would be able to raise that. So you have to kind of right size these metrics to your industry and to where you are. But when it comes to safes for founders, you know, I'm not even sure if we went into the detail on what a safe is, but simple agreement for future equity created by Y Combinator and Wilson Sonsini here in the Valley. And it basically is just a promise. It's a promise written in a contract. And the promise is, hey, when I end up raising a price round, then your dollars will convert into equity in my company. But for right now, you're basically just giving me this money and for no equity, for the promise of future equity once I raise that priced fundraise.
Yeah.
And so there's a lot of different terms that come across with these safes. The most important are the valuation cap and the discount. And you can see from this chart, you know, if you just focus on the right side there with the colors, basically 90% of the safes on Carta have a valuation cap of some kind. So it's very likely that your safe will as well. The safes without a valuation cap are very founder friendly, a little bit more common in 2021, not quite so common these days. But typically speaking, you have a valuation cap, and then it sort of depends on the negotiation with your investor, whether or not you also include a discount on that safe. Important to know that only one of those terms comes into play. The investor gets to choose which they take, the valuation cap or the discount, which is going to give them essentially more shares in your business down the road. But the reason that a safe has come to dominate this early investing is you've got valuation caps, you've got discounts, and that's basically it. You know, there's a couple other odds and ends terms that you need to be worried about, post-money and pre-money being the main one. But that's why it's so much faster and easier for founders to get going and fundraising on these, because they don't have to do due diligence on a full price round and take, you know, what can be weeks or even months to close.
Yeah. And I guess the additional point there is for investors and for founders, it delays that kind of pricing question. If there is, you know, uncertainty, you know, especially in the current market situation, it allows them to kind of figure that out over time. And just to maybe use a worked example, if you have, I don't know, a 20% discount with a 10 million valuation cap, if your next round is priced at $15 million, the discounted price to that investor that came in on the safe would be $12 million if they don't take the valuation cap, which it would be unlikely that they wouldn't, which would be $10 million, right? So they're essentially getting a significant discount to the round. And that's obviously one of the reasons why some investors like taking safes. I think the other thing, you know, we saw a couple of years ago, I can't remember, YCOM came out with some sort of additional terms in their own sort of safes, right, with most favored nation and so on and so forth, and that definitely complicates. So I guess, you know, one word of caution is, yes, these are definitely easier instruments than going through a full price round, but you still need to, again, to your earlier point, the devil's in the detail, right? You still need to make sure that you understand exactly what you're signing up to.
Definitely do not sign a safe without reading through it fully. That is fantastic advice, for sure. Just talking about the other instrument that's often comes into play at early stage, which is the convertible note. The main difference between those two instruments being a safe does not have an interest rate, so therefore is not debt, whereas a convertible note does have an interest rate and a maturity date for that interest, and therefore is debt. You can see that in some perhaps more conservative or quite honestly higher capital intensive industries like biotech, medical devices, hardware, etc. Convertible notes still play a pretty big role, whereas in standard SaaS, fintech, Web3, that kind of stuff, they're sort of on the way out.
Yeah, and that's understandable. Again, to your exact point, right? Those deep tech businesses are massively capital intensive. You may not be seeing any sort of revenue streams for 5-6 years post initial investment, and therefore you've essentially invested dead capital, so that interest acts as a proxy for the returns that you would otherwise be seeing by going through sort of larger rounds, pricing up, etc. But it completely makes sense. And I guess for software founders, I mean, the majority of software businesses move pretty quickly as compared to deep tech, and therefore they're likely to be going through those price rounds much more frequently.
Absolutely. And, we can wrap up here. I know the audience is probably not all from the States, so apologies for some of these that may be a little bit more US centric, but there's just been a fun, I don't know if you would call it fun, actually. There's always a consistent debate here in the States of like, when is the next Silicon Valley going to knock off the Bay Area, right? Yeah. Who's up next? What are they going to do to take over venture capital from its traditional home in San Francisco and the Bay?
And it was meant to be Miami for a long time, right?
Yeah, Miami got thrown around there. It's a new city every 6 months or so.
Sure.
I'm here to tell you that the data says good luck with that. It's not happening anytime soon. The Bay is either the first or the second most heavily invested metro for seed and Series A rounds across all of these industries on Carta. New York doing quite well in consumer and finance, and Boston, some really strong, a very strong performer in biotech.
Yeah.
But if you look at it as a whole, the Bay Area still maintains a really sizable lead over all of these other ecosystems in terms of total capital invested. So it's still the home of startups, and I don't envision that changing, in the nearish future.
Yeah, and I think, look, you, exactly as you say, it's sort of slightly different for those of us sitting in the UK, but it's actually also not, because if you want to build a transformational business, scale to kind of billion plus values, and exit, the US is still essentially the gold card. It is yeah. where you look to go to, and the Bay Area, obviously within that, within the US, is obviously the gold standard, right? So I think that it is super important. Obviously, Boston is very well known for kind of tech, biotech, and pharma. New York, you've got the New York Stock Exchange. You've obviously got fintech being a heavy player there. But yeah, the Bay Area clearly by far and away dominating the game there.
Well, speaking today from San Francisco, we welcome all London founders whenever you'd like to come over. More than happy to have you. I'll skip the safes one because I think we've already spoken about that. But just a little piece of data. Most of the interesting metrics that we've been talking about today have come directly from the startups themselves, the portfolio companies that use Carta. Carta also has a major business running the venture office for venture funds. We have a fund administration business. So VC funds come to Carta and we do a ton of back office work for them. And one of the advantages of that is we get this data on things like capital calls. So a capital call is when a GP at a venture fund actually calls money from their LPs. They have an agreement. They say the LP has committed such and such dollar amount to the fund. But the capital call comes when it's time to invest that money. We'd like to transfer it from one bank account to another. Yeah. And you can see there was a huge rise in capital calls month over month in 2021, as you can imagine, a lot of capital being deployed into startups. And then sort of a slightly more gentle but serious fall in that capital in 2022. And now we're just kind of trundling along, middling in 2023. So I think this is a good indicator for when the market is going to start picking back up as funds call more capital to have it on hand to actually start making investments again. I think that's probably a good leading indicator towards we're going to see more of that dry powder deployed into startups, hopefully, knock on wood, in the first half of next year.
Yeah, I think this is a really, really interesting slide, to be honest, because exactly as you said, it's sort of that leading indicator for when deals are going to start happening. But it's also, if one were to kind of look behind that, it's sort of symptomatic of rising interest rates, the fact that, allocations into venture have now become slightly outsized by some of the institutionals who, maybe have allocated 5% of their total portfolio to venture, but actually that's now expanded to 10% because of the way valuations have moved and because of the way the market's moved, and therefore they're kind of saying to VCs, obviously we've committed, but maybe you want to think about when it is that you actually give us a call.
It would be great if you didn't call this capital for the next 6 months. Yeah, exactly. we hear GPs tell us that all the time. They're like, look, our LPs, they may not explicitly say don't call this capital, but they're sure as hell pretty excited when we're not calling at the moment.
Yeah, it's really interesting. I think This is super important for founder. I always say to founders, you got to understand how the business of venture works in order to understand how that impacts, your ability to fundraise. And let's face it, right? Most VCs are somewhat like founders in the sense that, on a regular basis, they're going out raising money. In fact, not even a regular basis, on a fairly constant basis, right? Because you're always raising the next fund, even whilst you're deploying the previous one, right? And the only way you raise your next fund is on the performance of the previous funds.
Exactly.
And I think if you're a founder, you really should understand kind of the dynamic that's at play. And obviously, I see a lot of founders really frustrated about VCs maybe dragging their heels, not committing, etc. But what they haven't thought about is upstream. Those LPs are potentially also dragging their heels a little bit. And whilst there may be conviction with the VC, whilst there may even be intention and intent to invest, like there are other dynamics that are going on that may cause problems from that perspective. That's not to say that VCs should necessarily sit there and play with founders, right? Like in terms of timing, but you got to understand what's happening behind the scenes as well.
There's a really strong parallel between the founder experience and the emerging manager experience in many cases. We can speak, I think, in a completely separate voice about people like Sequoia, Benchmark, Andreessen.
Yeah.
Their LPs are, Stanford is not calling Andreessen and getting mad about a lack of deployment. That's a different relationship. But if this is your first fund and maybe you raise 10 or $15 million and this is essentially, the timing of this can be honestly a little bit tragic for these emerging managers because they just got the capital together to raise their first fund. And on the back of the performance of the first fund will entail the ability to raise fund 2, fund 3, fund 4. And if they don't do well in this one, they won't get the opportunity to keep investing in founders in the future. And so I kind of understand it from their end if they've slowed down the pace of investment because perhaps the fund is half deployed already and they only have a few bets and one of those bets has to hit.
Yeah.
And if it doesn't hit, they're not going to be a venture capitalist anymore. And that, people can cry tears or not cry tears for that, but that is a really important part of the venture ecosystem is having emerging managers come in who can hopefully give capital to people that are not exactly like the people who have always gotten capital.
Yeah.
So I think that this dynamic is really important and it's useful for founders to have that empathy for the investor and vice versa.
Yeah, look, and I mean, this podcast, I think essentially over the last couple of years has interviewed a ton of emerging managers. Like from the US, we've had people like Matt Conwell, Paige Findoherty, Mac at Rarebreed, Paige at Behind Genius. We've equally had people like Adam Besvinick from Looking Glass, and plenty of emerging managers here in the UK. And what I say is, in order to see real change in the venture ecosystem, you need that diversity, exactly as you said, you need that diversity of thought, that diversity of new and emerging managers coming in, taking bets on maybe underserved markets, maybe on underrepresented founders, etc., and seeing, that capital work its way through the system so that in 10, 20 years, that's getting recycled back up and you're seeing, broader trends or more niche trends becoming broader and, seeing diversification in the market in a great way. And I think the thing that would be really sad is that some of these managers, and I'm certainly not suggesting that those that I've mentioned would fall into this bucket, but there will be emerging managers, who raised funds for the first time maybe in 2020, 21, 22, who, may not be able to raise their next fund. And that will be a real shame because probably what is likely to have happened is, they've made some great bets, but equally the market's been against them. And there may be some, negative outcomes from those. So, it's 100%. Definitely really important to have that empathy, exactly as you say. And I think, founders and VCs essentially intrinsically tied in this ecosystem.
Absolutely.
One needs the other at all times.
It's such a great point. There is no venture world without both the investor and the founder. And no matter how many people come across now and say, look, you should be building your business entirely bootstrapped. That's the only way to do it. It's the only reasonable way to do it. I'm not saying that bootstrapping is bad. There's an amazing amount of businesses that probably should be bootstrapping aside from taking venture. But if you're going to have true venture scale outcomes, it is almost impossible to do that without some sort of venture financing model. There's a MailChimp every now and again, but getting to a $10 billion outcome just by bootstrapping, it's playing on whatever is beyond hard mode.
Yeah.
You know, it's really, really hard to do. So there's going to remain a place for venture in this ecosystem to get companies to the scale that of the, you know, the tech giants that we're all familiar with. And I just hope that, you know, not too many investors are knocked out by this downturn and they can be there to support founders for the next couple of years as well.
Yeah, look, I 100% agree. And I think that the other thing that we're seeing a little bit of is maybe a bit of a reversion back into kind of deep tech, so that, you know, a lot of VCs now investing in those capital intensive businesses that actually do have transformational outcomes, not just in terms of financial returns, but also in terms of kind of their impact on economies and so on. Peter, I cannot thank you enough for having gone into the depths of this data with us. I mean, yes, a lot of scary kind of data points in there, but I think also, you know, hopefully cause for some optimism as we move into 2024. You know, you saw obviously in that last slide that slight rebounding on the capital calls. Maybe we'll see the dry powder starting to come back out in 2024. Hopefully we'll see those founder-friendly terms continue to some extent, and maybe we'll see a few more price rounds being done. Obviously, there's some dead wood that has you know, sadly left the ecosystem. But as I said right at the top as well, you know, great companies are built in hard times, and I think that, you know, that still stands. So hopefully, what we'll see is founders building with a mentality of capital efficiency, which again is only going to be positive both for them as well as for their investors. Peter,
and their employees
100%. And, you know, maybe we should do another one at some point on the whole employee comp kind of situation, but I think that would be yet another hour of your time, so I'm hesitant to ask you to do that just now. Peter, for our audience, where's the best place for them to find you online? You're on LinkedIn, you're on Twitter. Where's the best place for them to look for you and the data from Carta?
Yeah, so obviously I am rather active on social platforms. You can find me on Twitter, X, Peter James Walker, and then on LinkedIn is probably the primary one. If you type in Peter Walker at Carta into your search bar, you'll find me there. And then, as you mentioned very kindly, the Data Minute newsletter comes out every Thursday morning. According to many people, it's well worth a spot in your inbox. So we touch on one thing from this venture capital data every week, and then you also get access to all of our full-length venture reports on the state of the market, the state of startup compensation, and many other things besides. So anything that we can be helpful for around founders, investors, and making this ecosystem a little less opaque, you know, that's why we exist.
Excellent. And look, for those of you that only caught the tail end of the show, or maybe weren't able to attend for the whole show, we will be releasing this as a standalone podcast as well. So we will drop some of those links in the show notes. For the time being, Peter, thank you so much for joining me. It's been an absolute blast. I can't thank you enough.
Absolutely. Can't wait to come back.
Awesome.